Hello there, and hello, Elsie. Thank you so much for joining us. So my name, as you know, John Thanassoulis. I'm a professor of financial economics at the University of Warwick, and I'm the course director for our Masters in Central Banking and Financial Regulation. And Elsie, you're the Deputy Governor of the Central Bank of Ghana, and I'm so grateful to you for agreeing to let me chat to you today.
Thank you, John. I'm most delighted.
So well, let's get right into it then, Elsie. So one of the first questions I wanted to ask you is, for Ghana, what are the key risks to sort of macroeconomic stability and financial stability that central banks like yours are currently worried about? And I'm particularly interested in how they might differ to some of the ones which the UK and the US and Europe might be facing at the moment.
Thank you, John. So I think we all know that in the year 2000, the WHO declared the coronavirus disease a pandemic. In Ghana, we had our first two cases on the pandemic, I believe on the 12th of March, actually. And then the whole world changed for us. Now, although we anticipated that the pandemic could actually be a problem for us, it wasn't really until it hit us in March that we began to see all of the ramifications of it, at least what we saw at the time. Some of the key risks to macroeconomic stability were the fact that real sector growth was about to be impacted, no doubt. With the onset of the pandemic in Ghana meant that the government was going to have to put in place health and safety measures, right? Restrictions in movement, in the way of doing things. And therefore, businesses were going to suffer. And therefore, you were going to have growth impacted, as well as government revenues from taxes being impacted. So that's one of the key macroeconomic risks that we faced. What's more, we began to see government having to spend large amounts of money on health spending that had previously not been anticipated. Very critical spending to save lives, really, even for testing and then for treatment, and also for prevention measures. And so this large spending was somehow met with dwindling government revenues on account of the impact of the pandemic on the real sector. And so you suddenly then were faced with a high fiscal deficit, which had to be somehow financed one way or the other. And therefore, government had to borrow more, increasing debt with all of its attendant risks, high risk of unsustainability of debt, basically government having to spend a whole lot of money on servicing this debt. And even market access issues, because then investors in government debt were beginning to be very wary of government's inability to service debt in those stress conditions. And therefore, we began to see a lot of foreign investors beginning to exit the local bond market. And that has implications for the currency, for the stability of the currency, and implications for the central bank's reserves, because somehow we needed to make foreign currency available for repatriation of investment capital and all of that stuff. So you had all of that playing out. At the same time, as many central banks did, the Central Bank of Ghana then had to provide some financing for government by way of monetary financing, which is something central banks don't like to do under normal circumstances. But because of the huge deficit on account of higher spending of government and lower government revenues, we needed to provide some funding to government. So we purchased a special bond issued by government in order for government to have some spending. And then the local banks stepped in as we found foreign investors exit the market. Local banks then increased the holdings in government debt as government needed to borrow more and more. And then that comes with attendant risks not only for the bank's ability to fund the private sector at a time when the private sector needed a lot of support from banks. This is the so-called crowding out effect, where banks then lend a lot more to government than to the private sector. At the same time, as regulators of the banking sector, we began to get concerned about the fact that banks' overexposure to the government sector meant that if government had difficulty in servicing its debts and had to restructure its debts, banks would take a hit on their balance sheet because all of a sudden their holdings in government paper would be haircut. And therefore we had all of these things playing out in our minds. So a lot of responses had to be put in place. For example, government had to reorganize its finances some way, somehow to make it more sustainable. It did not have the fiscal space that the US and the UK and the EU and other more advanced countries had. So we were starting off from a disadvantaged place, but they had to do the best they could do to save lives and livelihoods. And then on our side as a central bank, we needed to step in with some policy measures, including cut our policy rate, including provide some regulatory forbearance for the banking sector, so they could pass on reliefs to their customers, including debt moratoria, debt service moratoria, and other forms of loan restructuring to cushion their customers a little bit. So really, these are some of the things we've been dealing with. On the financial sector risks side, we're seeing a lot of MPLs build up. Basically, we're concerned about credit risk and liquidity risk in the banking sector as a result of the impact of the pandemic on the real sector. Banks' customers have faced some difficulty in servicing their debt. As I mentioned a little while ago, a lot of banks have extended moratoria on debt service to their customers, and we favored that. But that cannot go on for too long because we need to ensure that banks are reporting truthfully and as transparently as possible the impact of the pandemic on their loan books for the sake of the investing public. And so we're working this careful balance of how much more can banks do for their customers who are struggling versus really when should bank call up the losses on their loan book that would inevitably be the case, and who's going to ultimately pay for the losses that would ensue from bad loans that are not serviced as a result of the pandemic. And so these are some of the things that keep us up at night as policymakers and regulators.
Elsie, thank you. That's a very interesting response, and I think some of it is you've highlighted and explained quite well why it fits within the context of Ghana, but it also has a lot of parallels, I think, with many of the issues that other countries, including the UK, might face. And so, two policy responses that the UK has found appropriate for here, and I don't know whether they have echoes or parallels with things that you think about doing in your setting. So the first was the PRA, the Prudential Regulatory Authority here in the United Kingdom, stopped banks paying out dividends because they were worried that their balance sheets would become too stressed, and so they wanted to try and encourage the earnings to be retained to try and create as much as possible a cushion at the start of the pandemic. So I'd be interested in your views on whether anything like that is necessary or appropriate in your context, and also perhaps somewhat controversially, the not a central bank response, but the British government has also encouraged house purchases through a reduction in the tax that is paid when people buy houses. It's called stamp duty, as you know, in the UK, and so there was a stamp duty holiday, and that's led to a big increase, essentially, in domestic borrowing, and to some extent has kept the economy ticking along, perhaps even some would say overheating. That's not to say neither of those might be quite appropriate in your context, but are similar things appropriate responses in the Ghanaian context?
Thank you, John. So basically, we adopted a similar approach to what the PRA of the UK did. We immediately, in March, asks the banking sector not to pay dividends for the 2019 financial year. What had happened though was a few of them had actually already gone ahead to declare dividends for 2019 because of timing, right? Their financial statements had been, some of them had actually released their financial statements in early March. A few of these are listed on the Ghana Stock Exchange and had announced approved dividends for 2019. So that was a bit of a challenge in terms of implementation. And we had to work through that. But basically, we put in place a policy of non-payment of dividends for 2019 and non-declaration of dividends for 2020. And that worked well. Before the pandemic, we had the banking sector recapitalize. And so the banking sector was sitting quite pretty. And what we needed to do was to make them conserve a lot of that capital. Now, one of the measures we put in place was also, as I said before, to provide some regulatory reliefs for them. And what we did was to cut their capital conservation buffer by 150 basis points. We require banks on top of the capital adequacy ratio to maintain about 3 percentage points of additional capital as a buffer. We released about 150 basis points of that to them, as well as release a little bit of their liquidity ratios to them. So the banks were awash with a lot of liquidity. If you check the fact that they had just recapitalized, as well as the fact that we had given them these reliefs, so that they would be able to pass on some flexibility to their customers. But what we said was we needed them to maintain as many buffers as possible, and therefore we didn't want them to pay any dividends for the 2019 year. So that's very similar to what the PRA did. What we did for 2020, for the 2020 year, based on results that have been audited as of March 2021, was to say, based on our stress test results, we were going to allow banks that showed a lot of resiliency to pay some dividends to their customers for last year. And so we've allowed selected a very small number of banks who wanted to declare dividends for 2020 and who had the balance sheets to support that, to go ahead and pay dividends. But that was after stress test analysis that showed that even in the severest of scenarios, the banks will be resilient enough. So that's it on the dividend side. On the fiscal policy side, you remember that in response to the first question, I did mention that fiscal space for governments in developing and emerging economies is quite a different thing compared to what you have in the UK and other advanced economies. So while our government did its best to sort of stimulate demand, through its own fiscal policy, it didn't go as far back as further along as you did in terms of tax cuts, which essentially is what you did with the stamp duty cuts. So we didn't cut taxes. What government did was to spend somehow by providing additional salaries to frontline healthcare workers. It provided electricity and water for low-income groups for free, pretty much, and then it provided some small business loan support, and then even some grants for micro and small businesses. So that's what government did, really, by way of stimulating demand in the economy. We didn't do any tax cuts. In fact, for the 2021 fiscal year, there have been some tax increments to be able to pay off from some of the fiscal spending for 2020.
So Elsie, two policy responses that have been useful in the UK and may or may not have a reflection in things that Ghana finds appropriate are on the balance sheet side to try and increase the amount of earnings that are retained by stopping dividends being paid, The Bank of England implemented rules along those lines. And from the fiscal side, the UK government also changed the taxation around the buying of houses. Essentially, it was a big tax cut for people who moved houses, which has been controversial. Some people say it may have overheated the economy here. Do either of those two things have a reflection in what's been appropriate in the Ghanaian context?
Thank you, John. So, like the Bank of England, the Bank of Ghana required banks not to pay dividends for the 2019 financial year. So at the end of March, we put in place that policy with the same rationale, basically saying, listen, we need you to retain as much of your 2019 earnings as possible to be able to hold enough capital buffers for the inevitable losses that might accrue from bad loans and all of that. So that policy has been in place from last year. In March of this year, we issued another guidance to the public, to the industry, saying that we had conducted stress tests for the banking industry, and we would allow banks that showed resilience in the face of these shocks to be able to pay dividends for the 2020 financial year. So based on stress test results, we've allowed some banks who have requested to pay dividends for 2020 to go ahead and pay because we're convinced that they have adequate buffers in place, even under extreme stress conditions. On the fiscal side, we didn't have our government cut taxes for last year. What we did was have government spend, basically, to stimulate growth and really to keep the economy going. And it did that by paying a lot more allowances for frontline health workers. It provided free electricity and free water for low-income groups and households, and a lot more spending, including small business loans, grants to very small informal sector businesses, and a host of other spending measures. So all of that was meant to help sort of fuel recovery of the economy.
Okay. Let me turn to a different aspect of financial stability that is more long-standing, stretching back to the global financial crisis. So, as you know, partly in response to that financial crisis, the UK has implemented a ring fence to separate its own retail banking from the broader international sort of business that some of the banks do. And in the United States, same problem but different response. The Dodd-Frank Act had a different impact on the activities that banks could undertake. How has Ghana responded to the global financial crisis? Is any of these sort of policy moves appropriate in your context?
Well, thank you, John. So fortunately, before the onset of the pandemic, Ghana had adopted very important regulatory measures to strengthen financial stability. And this is really learning from the lessons of the global financial crisis. So in the year 2016, we passed a new banking law, basically along the lines of international best practices that gave the central bank a lot more powers for what is called early intervention. Or some would call it prompt corrective action. Basically, a host of very intrusive powers that allows the central bank to step in when it finds early signs of distress, okay, as part of its supervisory processes. And so these powers were given to the central bank, as well as even more intrusive powers to resolve non-viable and failed institutions. So we got a host of early intervention and resolution crisis management powers under the 2016 banking law. And so these sort of positioned the central bank with the tools to be able to manage crisis. Now, that was tested very quickly because in August 2017, the central bank had to resolve 2 failed banks. And then in the 2 years that followed, it had to resolve another 7 banks and then a host of other smaller failed financial institutions. So we're really grateful that the powers were in place before the need arose to use them. And in addition to that, we've undertaken a lot of reforms, including putting in place a deposit insurance scheme, putting in place a stronger liquidity assistance tool to support the banking industry in a way that does not sort of impair our balance sheet as a central bank, right? And then we have, as a nation, we've put in place a Financial Stability Council, which is made up of not only the central bank, which is the banking regulator, it has the insurance regulator, it has the securities market regulator, it has a pensions regulator, and then it has the Ministry of Finance, which is your chancery, and then it also has the deposit insurance scheme as a member. So this is really like a body of entities, all with a vested interest in the financial sector. And the mandate is really to strengthen regulatory cooperation, is together to identify and mitigate systemic risks. And then it is together as key stakeholders in the financial sector to prepare for crisis. So make sure there's a crisis preparedness framework that helps deal with crisis across the financial sector. So these are some of the measures we put in place to ensure that our financial system is strong and resilient. And if there are signs of distress or failure, we're able very quickly to step in to ensure an orderly exit of failed institutions in a way that promotes financial stability.
So that's very helpful, and yes, I'd read that that Ghana was able to resolve banks and had done so quite successfully. Before I go there, perhaps I could ask just a little bit more about that. The question of international banks in in Ghana. I mean, how do you trade off the sort of the benefits and risks of big international banks undertaking retail banking activities through sort of subsidiaries in Ghana? Is it that are big international banks great as a sort of source of extra capital that can come in and contribute by sort of offering banking services, or are they sort of a worry in that they can pull their money out too quickly and it can be destabilizing, and therefore one wants this sort of wall, which you might see the UK ring fence as a reflection of? How do you benefit from international big international banks?
Thank you, John. So we actually welcome international banks here. As you say, they come with a lot of benefits for a developing market like ours. They come with expertise, they come with high standards in terms of regulation, and they also come with a lot of capital. And so we do want to we see ourselves as a financial center, as a country. We see ourselves as a key player in the global financial system. And therefore we really encourage international banks to come in here, subject to the regulatory requirements we have in place. And we do have a few. For example, and these are all measures that we have in place to mitigate the risks that could be attendant to having international banks play on our market. We're very careful from the get-go that these institutions come in a manner that is ring-fenced from the rest of the group. And so while we encourage them to bring the technical expertise, the regulatory standards to bear on their operations in Ghana, we require that they're set up not as branches of international banks, but as standalone subsidiaries. And therefore, this, if you will, there is a legal ring fencing on an ex-ante basis. Okay, so they're set up as locally incorporated companies with their own boards, with key management personnel from here. And in fact, we even have a rule about 30% of these boards being filled by locals. And so we have a fair amount of local content as well. But it's important to us that there's a legal ring fence and from the rest of the group. We also have in place a number of rules so that intra-group dealings, in particular investments across the group, um, um, treasury dealings, outsourcing of technology and such important functions are all done with our approval. And so our supervisory staff are very vigilant on these things. We want to make sure that we understand where's the money moving. If there is a legal ring fencing, but we want to make sure that money from here, assets are not being transferred abroad, leaving behind liabilities on the balance sheet of the entity in Ghana, right? And so we're very careful about that. And then basically we enter into cooperation agreements and arrangements with the foreign regulators, with the home regulators. So we see ourselves as host regulators. And so we would very typically have bilateral MOUs with the ultimate home regulator of the group. And we even are part of supervisory colleges of some of these groups. And we are part of some crisis management groups as well. And so we really see ourselves as part of the regulatory arrangements for the group, and we like to have these relationships with the home supervisory authorities as well. So all in all, we believe that we have a balance in terms of the risks that may be pertinent, in dealing with these institutions, as well as the benefits that accrue to the nation from their presence in Ghana.
Okay. That I can understand that. It sounds very sensible. So I mean, you're a very successful financial sector. I agree, but there's always competition and for inward investment, and maybe Nigeria would also see itself as a possible destination for inward investment. Is the relationship between sort of your local other sort of neighboring countries, large countries like Nigeria, is that one of cooperation or sort of competition, or maybe a healthy blend of both?
It's a very tricky question. Ghana and Nigeria have a long-standing war on who makes the best jollof. You may have heard about that. So, jollof is a meal, is a rice meal, and there's a long-standing global debate on who makes the best jollof. But when it comes to financial services, we like to see ourselves as partners. We're neighbors, we're part, Ghana, Nigeria, and 14 other nations are part of the ECOWAS regional economic bloc for West Africa. And we do, in the context of ECOWAS, we have a lot of cooperation. Ghana and Nigeria are also part of the Anglophone, the English-speaking part of ECOWAS in West Africa. And we have a second zone monetary zone called the West Africa Monetary Zone. For these 5 English-speaking West African states, and the 2 countries play a very key role in moving things along. And so we like to see ourselves as partners and as key collaborators. They're competing for capital. We're competing for capital. We have quite a number of Nigerian banks actually operating the subsidiaries in Ghana. And so the Central Bank of Nigeria and the Bank of Ghana have a very close relationship in terms of cooperation, even doing joint inspections together, joint examinations of Nigerian banks in Ghana. We're part of supervisory colleges and all of that. So it really is a very, very important collaborative arrangement we have between us. And I like to see that, that's more positive than anything else.
I understand that. Now, going back to as you said, that the Central Bank of Ghana has been very forthright in protecting sort of the interests of Ghanaians and retail banking customers through resolution of banks. That's been in the paper. You mentioned a couple of cases, a few cases. I know there are others that have been reported as well. So can you take us through how the central bank gets the point of shutting a retail bank down and resolving it? What are the other possible policy responses? Is it, I guess it's a last resort, but what, perhaps you can fill us through that sort of fill us into that policy journey which ends up saying actually there is no other solution other than resolution?
Okay, so like I said before, from August 2017, we started what we called a cleanup exercise, which essentially was an exercise to resolve failed institutions. So that it started in August 2017. It went through to August 2019, at the end of which we had closed 420 institutions, 9 of which were banks, and then the rest smaller deposit-taking institutions in the nature of savings and loans companies, microfinance companies, and the like. No regulator would do this if they don't have absolute need to do it. I tell you, I kept saying that it was more difficult for us than it probably was for the owners of these entities, right? And the public at large. You want to use every tool available to you as a regulatory body and as a supervisory authority to help the institution recover from its distress. Institutions get into distress. You have a toolbox. You can do this. You can change management. You can change the board. You can restrict the operations. You can do that. You can ask them to recapitalize, of course, but they don't recapitalize. You can ask them to do something else, but they don't do it, right? You use all the tools in your toolbox while engaging very closely with shareholders, the board, and key management personnel, while at the same time having your eye out for how our depositors are faring. Do depositors have access to their funds when they need it? Could there be a run on these institutions? Could there be a run on even stronger institutions? How is this affecting the entire financial system? Because you had a situation where the depositors of these failed institutions were not just individuals and corporates. You had other financial institutions holding accounts with these banks and other deposit-taking institutions. So in effect, you had a systemic crisis on your hands. Now, what had happened was that the law giving Bank of Ghana stronger powers had been put in place roundabout in the summer of 2016. And at that time, the Bank of Ghana could have used more forceful powers to intervene, not by way of resolving or closing them, but by getting them to restructure their activities on a voluntary basis, under the control of their private shareholders. But that did not happen. Again, as a regulator, you're assessing, what tools should I use? How much time should I provide to shareholders to do this by themselves? When do I step in and all of that? So all of that went on. So maybe in a way that extended too much forbearance to these entities and their owners. But ultimately, it was just evident. One of the key problems that had been playing out was that a lot of these failed banks were not able to operate on a day-to-day basis without access to the financing window of the central bank. So they had become dependent on liquidity support from the central bank, although they were insolvent, although they had no collateral to back it up, although they were stripping assets at some point and all of that. And so, in the process of extending even more and more liquidity support to the banks, the central bank itself was endangering its balance sheet, because eventually all of these had to be impaired under accounting rules. And so at some point, it was just too late to do anything else, but just to close these down. They had ceased being viable entities. They had far reached the point of no return. And really, from our technical assessments, they had lost their franchise value. It was just easier to close them up and have them go. The manner in which we resolved them was key. We resolved them and put them under receivership, as the law allows us to do, and then gave the receivers the authority to do a purchase and assumption transaction. two of these entities, the first that were closed in 2017, August 2017, where we had the receiver enter into an agreement with an existing bank that was very healthy, a state-owned bank, that took on the good assets and the deposit liabilities of these two institutions under a purchase and assumption transaction. So overnight, depositors of these institutions had become depositors of a very strong existing bank, state-owned bank. So it was very easy to announce, to say, these two banks have been closed because they're no longer viable, they're insolvent. We have transferred your deposits to this new institute, to this existing institution. You can resume your normal banking operations with them. Now, because of the gap between the good assets and the vast deposit liabilities, government stepped in with a bond in favor of the acquiring institution so that they could make good the liabilities that had been transferred to them. In the case of the 7 other banks, government had to create a new institution called a bridge bank. The law gave government the power to establish a bridge bank, which is a new bank, if there was not an existing bank that had the capacity to absorb some liabilities and good assets of a failed bank. So government capitalized a new institution that we licensed to be able to take on the deposit liabilities of these 7 banks, as well as the good assets. Now, again, government issued a bond in favor of the bridge bank that allowed it to service the liabilities of the depositors. And most of these depositors didn't even take out their money. They were just happy to know that their deposits were safe with this new institution. So on the case of all 9 banks, the remnants, the bad assets, or the rump, as it's called, were kept in the receivership. And the receivers of these 9 banks now have the burden of trying to recover and realize some value from these assets, and then pay other creditors in line with the creditor hierarchy established under law. Now, why did government get involved in this business? Government got involved in this because of the systemic risks that there were to the entire financial system. At the time, although we had passed the law to establish a deposit insurance scheme, we hadn't actually started operating one. And therefore, there were really no safety nets in the financial system to help to pay for depositors. And it would have been very difficult if these depositors had been told to go home with nothing. And so government decided to step in to provide relief for them. So government announced very quickly that it was guaranteeing the repayment of all depositors in these 9 institutions, and even in the smaller institutions, just because of the systemic risks to the entire system, right? And therefore, it did cost a lot, something in the neighborhood of 5% of GDP by the time deposits in the 9 banks, as well as in all the other institutions we closed, have been paid for. So this is a bit of a departure from the learnings from the global financial crisis that said, if you must resolve an institution, do it in a way that does not lead to fiscal cost, right? But that presupposes that ex ante you have in place a deposit insurance scheme, which is well funded by the industry up to its target size, and which is able to pay within even 7 days, as a best practice would say. Or in some countries, in addition to that, you have a resolution fund, which is used to pay for resolution expenses. We didn't have any of that. So government stepped in. But the good thing is that after the cleanup exercise, we have, since November 2019, we have operationalized our deposit insurance scheme. And over the last 2 years, the banking sector has been contributing premiums to the scheme. And we're now managing the scheme and growing it up to a target size that allows us to be able to use that to pay for depositors' claims in the case of any future bank failures.
That's really interesting. It does sound incredibly well done. It raises a few questions, which I think people would be really interested in to understanding the experience that you've had in Ghana. Where to start? I suppose one question that occurred to me is an experience that a number of countries had. I know the UK had, was that the law as it stood made it very hard to separate out depositors from other creditors to a bank that was failing. So one absolutely can understand that depositors politically, and for lots of good reasons, one would not want to see them go home empty-handed, but one might feel differently with sort of big international sort of investors who had bought the bonds of different banks and then are supposed to exercise some sort of oversight, some sort of market discipline by requiring a higher yield, in particular if the bank is behaving in an overly risky way. And it was difficult to separate out those bondholders from retail depositors. It sounds like you were able to do that in Ghana. Is that correct? And how did you manage?
Well, yes, we're able to do that because the balance sheets of the banks in Ghana are very simple. They're not complex balance sheets. They're not market funded as much as you would have in advanced markets. Our capital markets are still very shallow, not deep at all. So basically, most of the liabilities on the bank's balance sheets here were deposits, very clear and very clear deposits. In some of these banks we closed, 9 banks we closed, there were a few of them that had lines of credit from foreign banks. Okay, and those were easily recognizable. Those were not deposits. There were lines of credit from very well-established foreign banks that was meant for trade finance or some other type of on-lending to SMEs and all of that. And we held the view, as you just said, that they had the capacity to have supervised these institutions, for want of a better word. They had the capacity to have sort of monitored these institutions very well because they had covenants in place and their lending agreements to them and all of that. So they could have done a whole lot more due diligence, which your retail depositor would not have been able to do. But then again, we didn't have any standing funds to pay anyone, and the assets of these banks were quite gone in terms of value. And therefore, this was government policy to pay depositors. And it was very clear. It was meant for depositors alone, not meant for other types of creditors. We didn't have bondholders. These banks didn't have any bonds on the market. In fact, the banking law under which we resolved these institutions gives us power to do a bail-in, i.e. to restructure debt on the books of these failed institutions. And so that people ask, well, why did you not bail in? Why did the government bail out depositors instead of bailing? Again, the question is the simple nature of the balance sheets. You bailing bondholders and more sophisticated creditors, but you don't bailing depositors, right? As much as at least the retail ones. And therefore, government's policy was based on the fact that these depositors were vulnerable. And in any event, it would have had a huge ripple effect in the entire system. And therefore, it was important to help these depositors. But the rest of the creditors, very easily separated from depositors, are waiting in line, and to the extent of any value realized from assets that are left in the receivership, they get to be paid with time.
I see. And so then a second question is, I mean, as you say, a central bank and Ghana included doesn't just willy-nilly just go and resolve banks. It's done carefully and with due thought and attention and care. But that therefore potentially also takes time. And that might mean that depositors might understand that their deposits are with an institution that looks like it's in trouble just from the local media and the like. Did you successfully avoid runs, and how before you succeeded in resolving and moving the deposits to a safer, larger bank, and how was that accomplished?
That was very difficult. I remember those days when I would wake up in the morning. There's a local radio station that had a 6:15 a.m. business news session. And my worst nightmare was to wake up to business news on one of these failing institutions, and occasionally they would publish something on the 6:15 news segment, and the whole day was a disaster, because we'll be scrambling around trying to figure out how to manage that. So that's a very difficult, it's always difficult through the process of consultation, and dialogue with shareholders and directors and board members. What do you do to safeguard the interests of depositors? And how do you know that the market won't go ahead of you? Because they may just force the institution into insolvency if you're not careful, before you take action. And so that's always a very tricky balance for resolution authority. In the case of the institutions that we did, that at some point it was inevitable that there would be some bad press, because depositors would go to these institutions for their money, and be told to come back and come back and come back. And so that really was one of the overall considerations that we took into account in doing this. But then what we did, we had to use a lot of very strong communication also around the actions, because we did it in segments. There was a point in time where the market wasn't sure whether there was more coming. Well, you closed 2 in 2017, and you closed 2 in March. No, in August, you closed 5 in August 2018. Oh, by the way, should we expect more? And therefore, what do we do with the money? And then when we were done with the banks, the smaller financial institutions were also limping, and it was evident because of depositors not getting access to the funds. And so what we found was a flight to quality. We were done with the banking sector cleanup, and the market wasn't very sure about what was happening with the smaller ones, because it was evident that there were a few of them that were struggling. So we found their depositors move their funds to the banking sector, right? So there was a bit of that there as well. But we actually had to engage the public very strongly, very frequently, through all sorts of media, just to let them know that we knew what we were doing and things were under control, and that everything was going to be okay. But it's one of the worst nightmares of a regulator, when you're trying to balance those competing interests.
And then the final question that it occurs to me to ask on this episode is that as you move deposits into sort of safe institutions, typically other already existing or sort of large banks, you have a natural process of consolidation, I suspect, so that the market becomes more concentrated in perhaps what you might think of as a flight to quality, in that, as you described, in that you have a smaller number of institutions which are hopefully well run and all carrying a lot of deposits. Is there a negative side effect in terms of competition if the market becomes too concentrated? Or is that manageable perhaps through other means?
Excellent. So we look at this from the overarching policy objective of financial stability. To be very honest, that is paramount. Financial stability, and then one thinks of competition. Okay, so what we needed to do had to be done. We needed to clean up the financial sector, to take out, the failed institutions, because it was a drag on the entire system, on the economy and everything else. So then in the process of doing that, we had to think of, well, will there be less competition? We didn't think so. I mean, we had, at the time, before we started our reforms, we had about 35 banks, very different banks, playing in different segments of the market. Some were at the high end, especially the international banks, playing at the high end of the customer profile, market profile. You had the more indigenous banks playing to the middle, and to the low end of the market. And so we believe that these banks had their own niches. And really, we didn't find evidence that consolidation would mean less competition in the market. We've always had an issue with getting the banks to be a little bit more competitive anyway, and we didn't think that shrinking the market would increase that problem. But then through our resolution effort, and also as a result, at the end of the cleanup, we asked banks to recapitalize. And in that process, we had banks voluntarily merge or acquire each other. So the industry shrunk to 23 at the end of the 2-year period. For us, again, the overarching policy objective was financial stability. And we were extremely happy that we had stronger banks, well capitalized, well governed, well managed, and depositors were safe. The entire financial system was safer. And then what we're doing on a day-to-day basis with the industry is to look at their pricing models, is to look at the business models, is to look at how well they're supporting economic growth through lending to the private sector and all of that. And then we have very strong market conduct rules in place that would deal with uncompetitive behavior, among other things. And so we believe that we have the tools in place to deal with any negative side effects on account of anti-competitive behavior.
Very good. I want to turn to, it's one of the last things, you've been so kind, one of the last things I wanted to ask you about. It really comes under the heading of fintech, but perhaps it's related a bit to your COVID response. So I suspect you're the same. We're discovering that because of COVID, a lot of people are having to work a lot more online. A lot of things are moving into a sort of a digital space. And there already existed the fintechs and their push to try and digitize banking. And to boot, Africa has actually been right at the forefront of developments of things like e-wallets and sort of electronic money. How is Ghana dealing with these sort of this wave of future digitization, and is it a risk or is it an opportunity, or maybe it's both?
It is both, actually. It is both, but let me say that long before the pandemic, we had been on this journey of moving things along, the worlds that we find today. It didn't, in Ghana, at least in Ghana, it didn't occur by accident. Right from the middle of the 2000s, from 2006, 2007, the central bank had put in place the infrastructure of a national switch that allowed electronic transactions to be carried out in the banking system and cleared and settled through a national switching system. So that started the whole process. We saw a move to more ATMs, card-based transactions, and we put in place not only the regulatory framework, but even invested in infrastructure that would support an orderly development in the market along those lines. We wanted to make sure that our payment systems was modern, efficient, but also safe for the financial system. And then fast forward to a few years ago, where the government embarked on its own effort to digitize the Ghanaian economy, because like many other emerging and developing countries, the economy is largely informal. And government felt that if it would put in place the infrastructure and the policies to move things along a more digitized world, we would get more formality in the economy that would translate into more tax revenues. It would translate into banks and other financial institutions doing more safer business with the rest of the public. And there would be more transparency and integrity in economic and financial dealings. And so the government embarked on the rollout of a biometric ID, national ID card, which everyone is supposed to have. So everyone now, most Ghanaians now have a biometric ID, which is going to be the one ID number for all transactions in the economy. In fact, more recently, it has also become the tax ID number. So from an ID card. Once you have the ID card, now you automatically have a tax ID number. Oh, so the market woman, the street seller, all of a sudden they're in the tax bracket. And before, there was no way you could find them anywhere. So that's how it started, right? And then government decided to also, digitize the physical address system, because we don't have a good addressing system. So banks would lend money to borrowers and not even be able to trace them after the fact. But now there's an infrastructure where every house, every dwelling place, every commercial space has an electronic address system that feeds into a national database that is now also linked to the biometric ID. And therefore, it's easy to trace people's identity and their location. And then government's own financial dealings, they decided to go on a cash light agenda, where all government services around the country are automated and payments are done electronically. So all of that gave a big boost to moving towards a more, if you were online financial services space. We at the central bank also put in place the regulatory infrastructure to allow for the emergence of mobile money years ago before now. And in fact, even before the pandemic, there were more mobile money accounts than there were bank accounts. There were like in multiples. There were mobile money accounts in multiples of what you have in bank accounts. And so we also saw the need to even amplify that through additional policy and regulatory measures, because that became a real game changer for pursuing our financial inclusion goals as well. So you're not only moving things along in terms of efficiency, in terms of more transparency in dealings, but you're also at the point where you can actually expand access to finance to everyone who has a mobile phone in every corner of the country. And then we embarked on other policies and measures, including opening up the payment systems to fintechs so that they could drive innovative products and services in partnership with the banks and other financial institutions. So today, most banks are able to very freely offer all their services and products online, through various devices, on your iPad, on your phone, everywhere, in partnership with fintechs who work at the back end. So at the onset of the pandemic, we already had the infrastructure in place. We had the rules of the game in place, including eKYC rules and all of that, tiered up so that it wouldn't affect the very small users of financial services. You do your KYC screening and all of that, but as much as you can do on a mobile phone. Before the onset of the pandemic, banks and other financial institutions were already lending to small customers on mobile phones. So the market woman at 3 a.m. is able to access a loan of a small amount of $1, $2, $10 on mobile, in Ghana cities, of course, on their mobile phones instantly. So when banks had to switch to a world where they had to close some of their branches, as a result of the pandemic and all of that, it was very easy for them. They just announced, well, don't forget you can use our electronic platforms, to conduct business. And then we, in partnership with the banks and in consultation with the mobile money operators and fintechs, also announced fee reductions in electronic financial services, so that it was even cheaper for customers to conduct their business through more electronic means. And then we had to sort of vary daily approval limits, daily transaction limits for purposes of KYC, for purposes of the use of mobile money and all of that, to allow more people to use these channels. And so it's come to stay. And thankfully, we saw that decades ago and have heavily invested in this space to a point where we now even have a fintech and innovation office at the Bank of Ghana. that is helping with oversight of fintechs and the involvement in the payment system and in the financial services industry as a whole.
Wow, that that does sound very impressive. You got yourself into an enviable position, it seems. So just to drill into that a little bit, it sounds like a good news story. So, but just to sort of drill to understand it better. So, two risks that there are with sort of the march of fintechs and this move towards a more digital future that that you're engaged with. One is that you might have institutions that don't currently have a banking license, which are essentially holding people's deposits. So electronic wallets and so on. Sometimes the money is paid into an entity, like a mobile phone company or something, which is de facto handling deposits of people, but isn't being regulated in the same way by the central bank, or might not be. Can that happen in Ghana, and is that a problem, or actually are there ways of managing that?
So one of the key risks we watch out for is exactly what you talk about, what we call the potential for regulatory arbitrage. And we look out for that, and we don't allow that. So what we do is, first of all, we don't allow telcos to play in the mobile money space directly. They need to incorporate a standalone subsidiary, which we regulate. So the telcos are regulated by the communications regulator, and we regulate the standalone mobile money operating subsidiary. So it's very easy for us to regulate the activities. The other thing is, unlike other jurisdictions, we put in place a bank-led model and a bank-based model, if you will. So even mobile money is really backed by cash held at a bank. Now, there is a transitional problem, right? I mean, if you went to give money to a mobile money agent, it takes maybe a few hours for them to take that money to the bank. So what happens in the interim? So increasingly, we expect that the money is sent to the bank almost immediately, and the mobile money operators are required to put in place measures to do that. But ultimately, all of the money on the mobile money wallet sits in a bank, in a trust account held in a bank, with the beneficial owners of those funds clearly noted. And in fact, the deposit insurance scheme even covers such trust accounts that are held with banks, backing mobile money transactions. So that's one way in which we mitigate the risk of regulatory arbitrage. We're very clear that banks and other licensed financial institutions are the only financial services providers. Everyone else is helping to provide more innovative financial services, and they need to stay in their space, basically. So we do have the mobile money operators at the front end a bit, but they're doing it with the banks in the back. And all the money is held in trust accounts that they hold at the banks. The fintechs are not allowed to provide financial services. They provide only technology services in partnership with banks and other financial institutions. So those are, of course, there's some blurred areas, and therefore, even within the central bank, the way in which we review applications for product approval is by bringing together all of the key departments: the banking supervision department, the payment systems department, the fintech office. All of them sit together to review from end to end, just so that we're sure that all the risks are identified. And also the other key risk is cyber risk, right? And more broadly, operational risks from, whether if there's a break in connectivity. We've seen the advent of a rise in cyber fraud and attendant risks, AML, CFT risks, and all of that. And we do have rules in place for all of these, and it requires a lot of vigilance. And I can't say that we're resting on our oars there, but we put in place a machinery to be able to check these risks, and we make the banks and their boards squarely responsible for identifying and mitigating these risks as well.
And then the final question, I mean, that sounds very, very sensible. I can see the logic in that. one of the sort of downsides of the success that you're having in making sort of credit more widely available, people even on their mobile phone able to get access to small loans, is that there can be, credit might go to people who are vulnerable and are going to struggle to repay. So it is possible, as we know from all countries, for people to need to have liquidity shocks, to want to borrow money, and then find themselves in a difficult position, unable to repay, perhaps even then borrowing to fund the repayments and getting into a debt spiral. Presumably, being able to access money on your mobile phone could make that worse. How do you make sure that vulnerable people are protected?
Very interesting. So we do this through a number of ways. Number one, let me start from the consumer protection side of things, right? And so we look at pricing, because when it started out, we realized that pricing was very opaque. How much is the market woman at 3 a.m. having to pay for that loan, that overnight loan, for example, and on what metrics is that priced, basically? That leads back to the issue of credit history and credit scoring, because these mechanisms, these ways of lending do not necessarily, they cannot, if they're to do the work, they cannot rely on a credit bureau and the credit and the established credit information database that's available for assessing and pricing risks. And therefore, they've come up, as you know, with their own algorithms, with their own ways of doing very quick credit scoring in seconds and minutes based on usage of credit, airtime, phone airtime, telephone airtime, and all of that stuff. How accurate this is a question, but basically we were very interested in how this was priced. So from the consumer protection aspect of things, we had very long discussions with the mobile money operators and the financial services operators to make pricing more transparent, and to make sure prices are quoted on an APR basis, even if it's for a day or two, but it needs to be done by the equivalent of an APR basis, so that we have a reference point for comparing rates across. And then also information and financial literacy is extremely important for us. So we've done a lot as part of consumer protection. We've taken the view that we need to empower the consumer to understand what they're doing, to understand the transactions they're entering into, and to be able to protect themselves. Okay. And then on the prudential side, we have taken the view that this form of lending, even if on mobile phones, is really part of lending for the bank or the other financial institution. And so the same sort of credit underwriting processes, the same credit risk management protocols must be put in place. Not exactly the same way, because by the nature of these loans, you need to be quick and agile and all of that. But we expect that they exercise the same governance around it. And what we began to see, especially from other countries, was the risk that people would borrow for uses that are not economic, and therefore their repayment capacity is affected. Also, the fact that they might actually borrow and throw the SIM card away. And so you might not be able to find them in a chain to recover your funds from them, and all of that stuff. And so we needed them to understand the risks that they were taking, and to make sure that they keep an eye on those numbers as well. And so we're sort of keeping these risks in mind, while hoping that we can really, as an economy, we can really derive some benefits also from this phenomenon, because it has the potential of being a game changer for micro business owners, for small business owners who need just a little bit, but don't have to go through the bureaucracy of applying for a loan from a bank in the normal ways,
No, I see. Thank you. Elsie, we've gone through all the questions that I had in mind. I think you've given some fantastic responses, and they've been fascinating for me, and I'm sure they will be for the people that that will get to listen to this. So thank you, thank you hugely. It's very kind of you.
Thank you, John. And it's really been a delight talking to you.